All right, let's talk about yield. All right, let's open up with introductions. I think we might actually get to all the questions since we're down 2 people. But so I've done a few panels so far and we never get to all the questions. So this might be the lucky one. All right, let's start with you. Who are you? What do you do?
Yeah, Sébastien Derivaux, co-founder of Steakhouse Financial. We are providing product for the stablecoin economy, mainly creation on Morpho, but also managing Grove, which is a sub-DAO of Sky.
So I'm Facundo Werning. I've worked in stablecoins for a long time at Tether. Now I'm at Agora. I head up Latam for the team and focus a lot on our growth and our partnerships in the region.
Hi, I'm Michael, the CEO of Liquity. Liquity allows you to take credit against your ETH with a cheap and fixed rate, and it allows you to save in the most trustless stablecoin. Only see you.
Great. Let's start talking about how the Genius Act has impacted how you think about yield on stablecoins. I know, Facundo, you were mentioning that that's had a pretty big impact for you.
Yeah, so I actually met a lot of the legislators when they came down here to Argentina a few months ago. There's a lot of limitations there. Obviously, you know, the bank lobby has kind of had their say. We've had our say. I think what we always want is, you know, we want consumers to have a great time. And so I think what's been great is it does have to be, you know, very secure, very high quality assets, which is always great. So you can sit in T-bills, you know, repo, reverse repo, cash, treasury notes. No one really does treasury notes. So it's mostly the other 4. Someone has a very boring job deciding what you're in out of those 4. But as far as the yield, one of the things is, you know, you can't pass on the yield directly to consumers. That's one of the things. And there are very strict rules with regards to also the naming and the nomenclature around a lot of these things as well.
So has that changed how you think about yield? You know, were you on a different path before? So wait, hold on a sec. Who's a stablecoin issuer here? Agora. And then, so this impacts you the most. So we have, I think the 3 of you will have very different points of view on stablecoin yield, right? So I'll come back to you, but what is your point of view on stablecoin yield? How are you bringing yield to users?
Yeah, that's a good question. So Genius is not allowing yield to be a process, that's true, except everyone gets a yield on their stablecoin because you just need an intermediary. With Genius, it's quite fine. If you have USDC on Base, for instance, you will get the yield. It's reward, obviously. You don't get the actual yield, but it will be very close to the reward you should get. So it will be more than 0. In Europe, we have a MiCA, which is a bit stricter because you cannot do indirect yield neither, but you can still have ways. And because most of the issuers are providing rewards to incentivize you to do some specific action. So it's not just for holding the stablecoin, you need to do some actions. So at Steakhouse, we are obviously, I'm bullish on giving the yield to users. That's why I was a long supporter of the yield-bearing stablecoin, which were the safe and the more responsible way of doing stablecoin on-chain, like Mountain Protocol or Paxos USDL. Now, thanks to the regulators, you are not allowed to get the yield, and those products are shutting down. They weren't in the US, but it's just easier to follow the US. We are providing vaults, so it's a lending facility, and that's how you get the yield. So the fact that the regulation doesn't allow stablecoin issuer to provide the yield is actually good for us. I mean, if I don't agree with it, that's why we have a business. So I kind of like it at the end of the day.
Okay, yeah. How about you, Michael?
Yeah, Liquity has a very different yield source. Usually kind of in the stablecoins, we move all the crypto collateral into treasuries. So liquidity moves into TradFi and then the yield is funneled back. Liquity is fully on chain. And Liquity is one of the few protocols that funnels the borrower interest directly to the stablecoin holder. So it's a pure on-chain yield. It's peer-to-peer finance and there is no intermediary. And I think we are the only protocol that funnels 100% of the borrowers just to the stablecoin holders. So that's like a closed system with its own yield source.
Okay, yeah, very different. Oh.
I think maybe, and it's quite a convoluted, you know, discussion maybe, but I think the real problem here is that there's lots of different types of instruments And these are all being called stablecoins broadly. The Genius Bill is very clear that if you want to be called a payment US dollar stablecoin, there's very specific types of assets you can sit in, and it's very specific, what ways you can give yield or not give on yield and the marketing, and it's all very, I think it's great. I think what happens then is that then you have a lot of companies that in crypto, they want to give more yield, which I think is, it's a fine impulse. I think consumers should have choices. We're working on a lot of this stuff. We think that there is a demand for higher yield a lot of times, and there are ways to get, sustainable backing on that. But I think where the real problem comes from is from this idea that there are a lot of things put in this bucket that's called stablecoins. That have nothing to do with each other, right? So we saw during this crash a little bit ago, where there's big depegs. A lot of these stablecoins have a large amount of looping activity, which makes them very volatile to small movements in price because people get liquidated very easily. And I think that is where the problem arises, is that you have many different things that are called a stablecoin. And I don't think any of these things are bad. I think the issue that maybe regulators are trying to grasp with is it's very different if you have, I have a bucket of debt to AI companies that are growing very quickly, and I'm tokenizing that, and then I'm rebasing that to $1 all the time, and I'm calling that a stablecoin, versus, I have, assets that are liquid to the tune of trillions of dollars where I can get liquidity instantaneously. Those are two very different things, and I think that's where consumers have a hard time parsing those differences, where if you have a background in finance, you understand very immediately, hey, if I try to liquidate 90%, even 20% of, these loans that, are backed by data centers, or just to, name one specific example, that is very different than, hey, I have, 90% T-bills that average 21 days or something.
Fair. So that kind of ties into the idea of a variety of risk for users. So as we're trying to get more and more user adoption, getting people to make their... Oh. All right.
You made it.
We've got...
Xavier.
You're Xavier, okay. You're in Julian's chair. All right, Xavier, hi, welcome. Where were you? No, just kidding.
Long story.
Welcome. Tell us who you are and... Oh,
that's Julien as well.
We've got a full house.
We are so back.
We're back. We're back.
So back.
Up only.
Like we've never been.
Okay, we have to keep the chairs straight. We can't look at each other while we talk. Okay. Ooh. All right, let's get some introductions from Julien and Xavier. Tell us where you work, and also tell us how what you do relates to stablecoin yield, like what part of the stablecoin yield world you're getting into. And when you're done that, we'll get back to what Facundo was saying, talking about how there's not just one thing that is a stablecoin, there's many types of stablecoins, and we'll go from there.
Yeah, sure. I'll keep it brief. My name is Xavier. I'm the founder of Frachtis. We raised $20 million this year. We're a crypto native pre-seed fund. We've made 10 investments to date, primarily investing $500K to 1 mil checks in early stage founders. The relevancy here is that my previous life, I was at Chorus One, which is a major staking company. So I'm very familiar with staking yield in particular. So yeah, looking forward to the conversations today.
My name is Julien Bouteloup, founder and CEO of Stake Capital. We've been in the space for quite some time, invested in more than 200 different projects. We also provide liquidity in the space. We have a quantitative trading desk. We also run Vec News, also created Stake DAO, and I was involved in Curve Finance for almost 4 or 5 years. And we created one of the largest auto market maker, a stablecoin, and I've been running Validator for almost 10 years.
All right, thank you. Let's talk about how users are using stablecoins, and specifically with yield. Let's get from each of you maybe the ideal way to chase yield in stablecoins and the riskiest way to chase yield in stablecoins. Let's start down there.
So the safest and the riskiest?
Yeah.
Well, maybe I start with ourselves. So I think we have a very safe and predictable way because we just pass through the borrower interest rates to the stablecoin holders. So you get the market rate. It's like a bit of DeFi treasury, I would call. So for people that like to be on-chain finance, I think that's a very safe way if you feel comfortable taking the technical risk and the oracle risk. So I'm looking at that, especially if your collateral, for example, is not rehypothecated and lent out, which is the case in our protocol. The most riskiest stuff, I think that's what we have seen that blowed up. You kind of trust somebody, you send your dollars somewhere, you have no idea what's happening, it's off-chain, they're looping and doing crazy stuff. I think then you just kind of pray and hope.
Did I just mishear you? Did you say that you are rehypothecating?
No, we are one of the very few where you earn yield and your dollar is just there, just sitting there, and you can withdraw at any time. You don't have many opportunities like that because everybody gets yield by lending out. So why are our users getting the yield? They're putting up capital to perform liquidations. That's what they are paid for. And I think the nice thing is, yes, it's not rehypothecated. That's why I said I think it's a very safe way to get yield on the dollar.
All right. What about a risky way?
Do you want to say a risky way?
Sorry?
Do you want to say a risky way? I think you were saying that some of these vaults.
Yeah, exactly. If the risky way is when you give your dollars and it's lent out and you have no idea what they're doing. It's kind of free pass. So then you're just blind because you don't know the risk and you don't know what yield you should get.
Okay.
I would say probably for the safer ways, obviously I'll talk a little bit, we custody our assets with State Street that has over $44 trillion custodied for customers all over the world. And the reserves are managed by Van Eck that has over $160 billion in assets under management. So, very high levels. Both those companies have relatively modest levels to extremely low levels of crypto exposure. And so, people always say, oh, we work with the first crypto bank. And it's like, well, actually, I'd rather work with a bank where I'm the only crypto guy, so they're not overexposed. You don't have a Silicon Valley Bank situation. And I think there's a lot of our partners that pass on yield in one or different ways. I know we work with some of the people on the panel as well for things. And a lot of the big blue chip DeFi protocols I think are great. I think then when you talk about the riskier ways to earn yield, it's always risk and return have to be together. I think there's a lot of these stablecoins that don't yield don't have very high amounts of yield. And then, they're in like some crazy debt related to AI, or like they have, some real world assets supposedly backing them. And a lot of these are also subject to looping, right? So it's not just what are they doing with the yield, but then what are the other consumers that are also in this? And so if a lot of people are looping and like 80% of your volume is looping, if you have a 20% DPEG, a lot of people will get liquidated and get very hurt.
Can you define looping?
So looping... looping is when you take out a loan against stable. It's basically a very high leverage loan that you're taking, maybe in simpler terms, right? So you're trying to maximize yield. So against a very small amount of collateral, you're taking out a very large amount of a stable coin that is yielding.
Yeah, on my end, I fully agree with Facundo. The safest way is you need to have in some institution that is issuing a stablecoin or any product, but it should be based on T-bills, no strange counterparty risk, big custodian, those kind of stuff, very simple. The yield might not be good. If there is a yield, sometimes it might be difficult for you to access. For instance, you have Bridal from BlackRock, but the minimum size is 5 million, and you need to be KYC'd, and it's not very liquid. It's very liquid itself, but it's difficult to access on-chain, for retail people at least. Then you can go to lending. For instance, at Steakhouse, we have the Steakhouse USDC Vault, which is $500,000. We're also providing the product for Coinbase users. Lending is blue chip asset. So that's, in a way, quite safe. There is oracle risk, there is a technical risk. But if you look over the last few years, since lending exists in DeFi, there never was an issue on that, or more or less no issues specifically on those collateral. Then you can lend against more risky assets. Then you are taking obviously more risk, as we saw recently. and you always need to think about solvency of the protocol you are using. So will you get the money back? And liquidity, how fast can you get the money back? So as you mentioned, some stuff where you're lending on private credit, investing in private credit or GPUs or real estate, those stuff tend to be a bit more complicated. And it's more difficult to underwrite at least. And then you can go on leverage looping, as you mentioned. I would say that's the most risky part. There is a safe part that we are not focused too much, which is yield farming. Good transition. VC tend to finance startups, and startups to succeed need to incentivize you to use a product. By using the product, you might have a good risk-adjusted yield because someone is paying for it, just for you to use it. Obviously, that's not sustainable. It requires a lot of work because you need to move from one opportunity to another. And at some point, there is a smart contract risk and you lose everything. So it's not riskless, but if you put the work, you can find great opportunities.
Yeah, I can maybe come at it from a more VC lens. So we primarily transact with USDC and, sometimes even with some of the work that Steakhouse does on chain, put that to work. So I think for us, as a VC fund with LP money, in terms of safer yield opportunities on chain, you have sort of centralized exchanges, which we try not to keep too much capital on. And then we have sort of decentralized things that we do on chain, for example, like Morpho, Euler, Aave. Of course, all of these things now have some very small level of smart contract risk. In fact, I think Balancer recently sort of proved that none of us are necessarily safe. So that definitely made us rethink where we're putting our capital to work to earn yield. On the more startup side, I would say we look at some more higher risk yield opportunities in terms of investments we make that are generating higher yield. There are some really interesting things being built right now, I think, in that space. And I think when it comes to yield itself, I guess from our experience at Chorus One, so much of it comes down to product and distribution. And so there's a question with users, there's a lot of things you can talk about yield or the risks, et cetera, but the end user for a lot of this stuff is really not even aware of, I guess, the risks behind the yield itself. They're probably just using a product and they see a number there. In fact, many people don't even know what yield is. I guess long term, when the whole world is using crypto rails, I think many of them probably won't even see the number or even know what yield is. So I just think we really look for products as opposed to protocols now, I would say. So I think there are already some amazing protocols. Of course, these guys work with many of them as well on chain. And these protocols are getting to a level now where you can kind of build consumer products and apps on top of. And so, yeah, there was a cool startup yesterday I caught up with. They're generating 14% yields, pretty sustainably, working across Euler and Pendle and actually composing on top of some stuff that Steakhouse is doing. And I've been pushing the startup quite hard to focus on the end user, distributing it to people outside of crypto as well. And so I'm very bullish on yield where they own the power and the end user, because I think that's really where all the value will accrue to startups long term, and even anyone in the yield space for that matter. So that's my lens.
Well, I believe the major problem in the space is the definition of stablecoin. I would say 99% of stablecoins are not stablecoin. They are advanced exotic structured products, and only 1% are actually pure stablecoin. So when users are chasing yield, they really need to understand what type of yield they are after, because if it's a structured product, exotic type of product, then it's very likely that the risk of losing the capital is pretty high. And if you don't have, I think the market will really change in the coming months or years, where you have counterparty or insurance that will provide insurance product for a stablecoin, real stablecoin. So for example, if you have a DPEG, you get your money back. And this is actually a proper stablecoin, because you have someone that take the risk of a DPEG, which basically showed that that product is a real stablecoin. But you will, if you have an insurance product, I believe that they will only provide that type of feature to 1% of the market, and this will really define what are the stablecoin and what are not the stablecoin. So I think there's a misinterpretation of what is a stablecoin in the space, and we tend to look at everything that call themselves a stablecoin to be a stablecoin, but they are not. And it's what makes the space extremely dangerous for retail. And usually the bigger is the yield, the less is a stablecoin.
Yeah, that's an excellent point. And I just keep thinking about how what you're saying and what you were saying, it's almost hard to be up here all talking about this one topic when it's actually like 10 topics rolled into one.
Yeah. This is where, if you have a portfolio of data center backed loans or whatever that I was saying, that's very akin to what you're saying, Julien, where, that's very different from, I'm holding 90% T-bills that will have liquidity in 14 days. Like, these are two very different things. And arguably, I think they should not both be called stablecoins. And here's where we probably need people on the front end and people to do more education. It's just fundamentally a very different product.
Totally. Let's jump onto something that Sébastien mentioned, which is incentives. Incentives drive a lot of yield and certainly some of the riskier yield. Let's start with Sébastien. What do you think is the role of incentives today, and where do you see that evolving?
Yeah, so it's a very dynamic space, DeFi and crypto in general. So there is a lot of activity, a lot of new ideas coming in, but there's a lot of noise as well because a lot of things are happening. I mean, I'm working full time on it. I don't understand 90% of what is happening. If we look at people that want to list their new stablecoin or collateral or whatever we want to call it on our vault, we get 2 or 3 requests per day. There is no way we can analyze everything. So we need to make a very big decision on that. And sorry, I forgot the question.
Where do you see incentives going?
Yeah.
Do they prop up? Are they propping up?
So to
our
go outside of the noise and sell their product, those new companies, new protocol, new startups need to have incentives to justify for people to understand how it works. And so, for instance, you might have, for instance, Open Eden. That's a stablecoin that is Bermuda regulated, CUSDO or USDO. You need to understand why there is a C version and a non-C version, what's the difference. But so to create some traction, initial traction, because they create a lot of incentives, and you have some pendle token on top, making some a higher yield because some people are buying the points on the token or whatever they are giving. And that creates traction, and that shows the product to a lot of users that initially are just coming because there is a good yield. And that's a way to get new users. Obviously, the question is that sustainable? What I see usually, and what we see usually, is that when someone is incentivizing quite a lot, it creates traction. You might get to $500 million TVL quite fast. But when there is no incentive anymore, money tends to leave to the new yield opportunity. But at the same time, it's still a good way to start. It's a very expensive way to start. But so at least you retain some people and you get some PR mention and people get, oh yeah, I used this product 6 months ago. It worked, so maybe I can use it again.
I think incentives are probably unfairly maligned a little bit. I don't know if you guys agree, but I think incentives are a little unfairly maligned. Like everyone does, like a new sandwich shop opens down the road and they'll do, 50% off because we're opening. And like, we all think this is normal, but then for whatever reason, when it happens with financial products, people say, this is like incentives. And yeah, they want you to try out the product and see if you like it. And I think that's fine. I do think you have this thing that happens that obviously, you have this very active capital, maybe some of the guys on the panel, that is chasing yield specifically for LPs. And so, yeah, once you turn off the faucet, they're going to go to the next sandwich shop offering 50% off or whatever, because they have a duty to their LPs. But, you can also try to discern what kind of users you can get. And I think there's a lot of ways you can do that.
I do think something interesting that I could see happening, particularly in the real world asset space in the next sort of year or two, might be discontinuation of some of these incentives. I guess from our time at Chorus One and operating all these proof of stake blockchains, we've seen over time, many of these chains have ceased to exist, first of all, because they didn't pick up enough activity. And the ones that have survived, you can see the governance proposals today, and many of them are trying to cut incentives and yield. And I think that's they're always the pioneers, in my opinion, of the yield space in crypto, and a good sign of what is to come, I think, in other sort of categories of yield in crypto. And so I personally feel like these real world asset incentives in particular, and maybe some of the other things going on outside of that, probably have a limited lifetime, and then it'll settle down to some sort of smaller number long term, and very few will survive, just the dominant ones that would then end up being adopted by, I think, some of these players up here. So it'll be interesting to see, I guess, the yield in the year or two, how sustainable it is for these kinds of emerging categories, and if it will suffer the similar fate as proof of stake, because I would assume it might. Be curious to hear Julien's take on that though.
Well, my take was 99% of stablecoin are not stablecoin. And I would say that 99% of most products that are using stablecoin are not real products. So I don't really necessarily agree with what you said. If you go to a shop, they might offer you 50% discount, but then they expect clients to come by because they have expenses. They're selling something, so they will...
No, I agree. I mean, you don't have to go back to the sandwich shop. I'm just saying, I think incentives are sometimes unfairly maligned.
Yeah, but the problem is like in this space, most of the product that people are building is not actually building for intrinsic value. They're not actually creating something that's solving problems. If you compare the market to AI, you have billions of dollars being injected, but you also have a lot of retail paying for the product. So they can have a vision, they can plan for the next couple of years with correct P&L, ARR, and they understand financial expectation over like type of discount and type of incentives. And that's what's missing in the space, is really about trying to build something that is really solving a problem. I think in Argentina that's the reason why this conference and DevCon is very unique this year, because we seen that stablecoin and crypto has really helped a lot of people here, because to save value from their work, to counter or hedge themselves from hyperinflations. So it's real product. But in the stablecoin space and yield, most of the product that people are chasing the yield are actually not really providing any value. That's the problem.
Agreed completely. I think there's two different worlds in crypto that we're seeing. I think crypto in emerging markets is very different from, sometimes I'm a little mean. I love the people out there, but like crypto in Bushwick, I've gotten paid in stablecoins for the past 5 years at this point. So I've been a big user, and I'm from Buenos Aires. And so I've seen people using AUSD to get cash this week, for example, to get physical pesos. I agree completely. There's two different worlds. What I mean is just, I think incentives are maligned as something bad. And I think when there's an honest story about, hey, we're giving you an incentive so you try out a product, and if you like it, you try it long term, and we structure it in a way so that it's sane and it's healthy for both parties, I don't think that's necessarily bad. But I agree with you. Obviously, it's an incentive. It's going to come. It's going to go away. Probably most people cannot sustain. They haven't raised enough funds to pay whatever percentage they're offering nowadays. And then the other thing, a lot of people will say, oh, targeting this much, and then they're not really going to hit that much, right? That also happens.
All right. Anything to add? It's okay if no.
No, not that much. I think we've covered it. Honestly, the incentive part, I don't find it so interesting, because somebody has to pay for it. So the backers or the VCs. For the users, it's great. They get rewarded. That's how it gets bootstrapped. And you need to know, is it worth? Do you have a good product? Does it really help to get exit velocity? And I think then it's a good mean. Or the other use case is you want to pump with the TVL and the token. That's probably the other use case. And that's about it. So I don't find it so interesting. I find it more interesting to talk then about the real yield of these products and the risks that are. I think for users, it's great. They get extra money. Like if you sign up for Revolut and they give me $50 to do so.
Yeah. You said it's more exciting to talk about the real yield.
And the risks. Yeah, I think that's where we have seen what blowed up, how users behave, and where kind of...
So
we need some education, I think.
What's the real yield?
The real yield you get from the underlying that is sustainable, that is not subsidized. And there are different yield sources. So you can get that from treasuries, T-bills, from other DeFi users that are borrowing, or from LPing. So there you have different yield sources, and that's for me the real yield. And the yield has always a profile, and I think you need to understand what you're looking for. How volatile is that? How predictable is that? Is that in stable coins? Is that in a coin that can deflate? And just there, I think, again, like with the stable coin, we throw everything in one bucket, and it's just a yield number. And understanding a bit the yield and what's behind it and what risk is behind it, I think that was a bit a wake-up call the last weeks and months, I think, for the space.
Yeah, I'll say something spicy. I think a lot of people who call themselves a stablecoin should probably, I don't know if not allowed to, but I definitely think front ends in the industry should probably be more clear about, okay, this is a yield coin, or this is a tokenized hedge fund that's rebasing, versus this is a stable coin. You know, you can agree or disagree with where the Genius Bill set the line. But I think what's clear is that, you know, there's a big difference between, oh, you know, we're sitting in 90% T-bills, 5% cash, 5% repo, versus, oh, you know, we're, you know, a delta neutral hedge fund with dependencies across 10 different centralized exchanges and a couple decentralized venues and whatever. And the second product can be great risk return adjusted, but it will usually intrinsically have a much higher risk than the first. I think that's where probably a lot of the front ends need to step in and be more honest to the user about what's going on underneath the hood.
100%.
I think so. I fully agree that we should have a word for something that only invests in T-bills. Lending like Liquity maybe should be, it's not the same because there are some market control risk, so I agree. But for instance, you can have a yield and be just in T-bills and banks, tokenized bank deposits. I mean, we don't say they are stablecoin, but they could be stablecoin, and they are fractional reserve banking. So that's not fine. For instance, there are some stablecoins that are MiCA compliant. The only investment they have is bank deposits. What is a bank deposit? It's not a T-bill for sure. It's fractional reserve banking. But it's still completely regulated. And let's be honest, it's still quite safe. Because if I have my money in a global systemic bank, nothing will happen, even if it's not T-bills. But it's completely shady. It's shady underneath, like any bank. You will not see the balance sheet as of today in granular detail. While you can have it for some DeFi stablecoin, you can see what is the exposure I'm taking every day or every block. So I think it's complicated, but I would agree on the directional.
I may be a little bit more skeptical about some of these banks, particularly, I don't want to pick on my friends on the old continent, but in Europe, a lot of these banks are doing this hold to maturity accounting, you know, and their balance sheets are looking a little shaky. But yeah, in principle, agreed.
Well, SVB that did hold to maturity was in the US, so.
This is true, yes, of course.
But I agree with the banks, and I see it really dual. I think we will have the regulated stable coins, and I think they're great. You know, a Paxos dollar is a great dollar, much better dollar than your bank dollar, because they make money with it. So it's much more secure, and I think that's totally legit. And then I think with the other end, where we are maybe more, where you say you do a decentralized stable coin, a truly digital dollar that only lives on chain. I think that has also a use case. And I think everything in between will be difficult from a regulatory point of view, or is then some kind of money market fund strategy that is doing something. But for me, the world will become quite dual, and everything in between is in a gray area. Either it's regulated or, you know, they're doing just kind of some strategy with it.
I think we can all agree the banks aren't great, right?
No, I'm pro-bank. No, but speaking of banks, you know, if we take away yield opportunities like lending or liquidity providing, we really focus on the stablecoin, like direct stablecoin yield opportunities. If the interest rate environment continues to decline, if yields get lower, if interest rates keep getting lower, do we lose an edge? Do we lose an edge with stable coins to the banks, or not? What do you think? Or do you think rates will go up?
Well, if you think from the compliant stablecoin under Genius or MiCA, and we assume there is no loophole, so they cannot give the yield in any way, I would say it should actually be better. Because if interest rate in SOFR or bank deposits, saving accounts, what they are offering with the banks is going down, and as the payment stablecoin cannot offer you any yield, then it's become better and better to just hold the stablecoin instead of a bank deposit.
Yeah, demand deposits don't give yield in banks today, right? But so I see what you're saying. But what about
some are. I mean, obviously there are trade-offs, but yeah. Yeah, they are not giving a lot, let's say 5 bips.
Yeah.
But 5 bips is better than what you have on the payment stablecoin that is not allowed to give you anything.
That's fair.
But obviously, with the stablecoin, I think we can all agree that you have the utility, it's more efficient, it's settlement. I really prefer to transact in stablecoin. All companies doing a stablecoin, using stablecoin for any payments, and banks are always an issue to work with. So There is a utility
Yeah, and
value
it's
of the
true.
stablecoin.
You often can't get the yield directly for regulatory reasons and whatnot. But the reality is most users holding these payment stablecoins are holding them through some kind of intermediary that, in some way or another is paying out yield to them. Some more sustainable, some less sustainable. But usually they're getting it. You have very few people sitting on a balance of, however much, whether that's, Agora or a Circle or Tether or whatever you're talking about, and it's just sitting there in their wallet doing nothing. If you stable out, at least try to get 4%. You should. I see a lot of people like stable out and they're not even getting 4%. And it's funny because in the traditional financial world, it's like it's free. It's like that's why it's called the risk-free rate. You should be careful of and wary of what kind of intermediaries you're working with. Make sure they're high quality. Make sure they have a track record. But within that, if you stable out, get some yield. Don't just stable out.
And I think, as you said, if rates go down, you will earn less. But there, it really depends on the yield source. I think for treasuries and decentralized stable, yes. But I think, for example, in our case, we have a totally different yield source. So if crypto is going up and people are leveraging because we pass on the borrow rate, you could get a really nice yield. So that's why it's important to understand that the different yield sources that stablecoin brings to the user. So we are like a decoupled yield source. So we are more dependent on what happens in crypto.
Oh, the question was, are we losing an edge compared to the traditional financial world, right?
Right.
Over the past few years, we've been calling TradFi to start adopting DeFi and whatsoever. It's really happening, and I think they're coming at our free lunch, and so DeFi players have been saying, they don't understand. They should be using it because it's really solving problems. They can save money. They can be more efficient. Well, this is now starting to be a reality, and you have hybrid startup TradFi application like Revolut, Robinhood, that now are starting to adopt a DeFi in order to be more efficient, save money, and provide better products for retail. But then DeFi on the other side will suffer because those projects, startup, TradFi, hybrid DeFi, will have way more access to bigger markets and way more power executions. So it will be more and more difficult for DeFi players to actually compete with hybrid TradFi players. And this is something that we've already seen. I remember like a startup was saying, but we've been building something like similar to Bridge, but Bridge got acquired for billions, and us, we just a few million US dollar valuations. Yeah, but this is the reality of the market. You have now more sophisticated players coming from traditional finance that start to understand DeFi and are providing product that we've been using, but to TradFi players.
Yeah, I've been speaking with a few sort of consumer credit startups recently, which are pretty cool, and things ranging from buy now, pay later to tokenized credit. And yeah, I do think that especially banks that feel like they're behind the eight ball when it comes to the crypto regulations and all of that, community banks in the US in particular, like they want to move capital in size to some of these DeFi opportunities. And I just think that will be a very interesting yield source, I guess, and sustainable yield source, I think, as these major players come into the space. So it'd be interesting to see, I guess, how these guys team up with these kinds of banks as they come on chain.
All right, we're out of time. I really enjoyed hearing all of your opinions and information, and I hope that you all have a great rest of the conference.
Thank you.
Thank you very much.